Hey everyone, Anthony Benuto here with InTouch Mortgage Solutions. It's Friday, Finance Fridays, and thank you again for tuning in for another episode. On this episode, we're going to be discussing leverage and how to grow wealth through using your equity that you have in your home. So stay tuned, we're going to dive right in. Once again, I want to take this opportunity to continuously thank all our supporters and viewers of the channel, everyone taking their time out of their day to help support, comment, leave questions and feedback, sharing our videos, and helping get everyone engaged when it comes to financial literacy and mortgages and real estate and everything in between. On this episode, we're going to be discussing a topic that was sent to us that we actually just did a webinar on with regarding leverage and how to utilize the equity in your home to help increase or grow your wealth. Now, for a lot of clients that we have, a lot of them who are real estate investors who are looking to diversify their portfolio, a few of them had maybe some money that they wanted to utilize towards purchasing a rental property, but unfortunately with the current situation for the market, are hesitant or not able to get into the market as the barrier to entry for a lot of investment properties might be out of range for some people, or out of province or out of town. So they're looking for other ways to maximize their wealth potential. So one element that we were talking about in our seminar and webinar was how to leverage your equity in your home to put it towards an equity markets or maybe the stock market. Now, please keep in mind that this concept is not for everyone, and basically you have to be able to stomach volatility and you need to understand time horizons. So this is why we say in this component or in this video, please make sure that you speak to your mortgage professional first and foremost about obtaining equity if that is your goal. But secondly is consulting with an investment advisor, a trained and licensed person that can help you, set up the process and basically give you some insight. Now, there's a lot of websites and a lot of programs to help you self-invest. But as I said, you do need to understand your risk tolerances, and that's sort of things that we're going to talk about in this video. So first and foremost, obviously, we've seen the market change in the last few weeks. We've also seen how the Canadian landscape has changed over the last 2 years, where we've seen home prices across Canada surge to over 800,000. We've also seen local home prices in the GTA and surrounding areas jump 15 to 30% and more in some pockets. Obviously, a lot of Canadians who have put money aside and trying to save have noticed with the rate of inflation that their savings are being eroded as the cost or the dollar doesn't spend the same. So a lot of our clients are looking to put their money into hard assets, and they're looking for ways to invest and grow their wealth, whether it be to top up their RSPs or contribute more to their TFSAs. Maybe they have young children, families, maybe they're clients who are a little bit elderly and have paid off their mortgage, but now looking to aggressively put money into a savings plan to help them retire with ease as the cost of living is getting more expensive. One thing to understand that the market is shifting, and understanding how to tap into your equity can be, maybe a little bit overbearing for many Canadians. So there's two ways to really tap into your equity if you own a home. You can either do your conventional refinancing model, which means you're pulling the equity out of your home and basically just amalgamating everything into one simple mortgage. But that is good if you know exactly how much money you want to pull out, or if you have a dedicated plan. And sometimes adding a line of credit to that, or a home equity line of credit, can be beneficial. One important distinction between a home equity line of credit and an unsecured line of credit is obviously the interest rate, because one is secured against an asset and the other is not. So generally, we advise clients, if you're planning to borrow, you have some projects or something that you want to leverage that equity in, is to use a secured line of credit, as the interest rate will be lower, and if you're investing, your rate of return will be greater. So understanding that component, there's your two ways: refinancing and potentially maybe keeping your existing mortgage depending on your lender and adding in a line of credit. Now, one important aspect is that your lender has to offer or be able to provide you with a home equity line of credit. So if your lender doesn't offer that, you might be forced to restructure and move your mortgage and get a line of credit with a different lender. So now, when we talk about lines of credits and investing, it's important to understand that everyone has different goals and objectives. Some people might want equity, some people might want to buy stocks or crypto or NFTs. There's many different forms of investing. It could be physical assets, it could be anything that your heart desires. Now, as I said earlier on, it's important to discuss those decisions with a professional or trained professional who can help you plan and set together a plan, or put a plan in motion, I should say. And understanding the volatility, the risks, and basically your horizon, how long it's going to take you to achieve your goal. You can sit back and recalculate all your information, say, look, if I want to retire with this amount of money, how much money do I need to put aside? Now we've talked about general concepts. Let's talk about how a line of credit, or what is a line of credit. So how can a line of credit help you, and what is a line of credit? A line of credit is basically also secured against the home, much like a mortgage. It just acts a little bit differently, where it's more of a revolving credit. So based on the appraisal value of your home, based on your income, your credit, and your qualification standards, the lender will predetermine basically how much money they can lend you or give you access to. Generally, lines of credits will range from anywhere from 65% of the equity in the home, and in certain cases in a hybrid model, up to 80% of the value. So for example, if you had a home that was worth, let's say, $1 million, and you were looking to get a line of credit, you didn't have a mortgage, and you said, I want to get a line of credit, it would be up to 65%, which would be $650,000 as a line of credit accessible to you at any time. Let's say you wanted to get a line of credit, but you have a mortgage component. You can either go up to 65% minus or deducting the mortgage scenario, or we can move to a hybrid model where we can say, look, $1 million home, $800,000 of qualified borrowing power. We can compartmentalize it to $400,000 mortgage and a $400,000 line of credit to achieve a global limit of $800,000. Now, there are many different ways. If your mortgage is larger or greater, depending on the size of your mortgage, they can be different. But within those home equity lines of credits, some lenders allow you to compartmentalize actually maybe a certain amount of it. So let's say you want to borrow $50,000. So $50,000, let's say at 3% will cost you $125 a month. And that basically is the interest-only portion, as lines of credits are, you're only required to pay the minimum of the interest-only portion. But you can pay as much or as little above the interest as you would like, and can carry that balance on the line of credit. Unlike a traditional mortgage, where once you get the money up front, if you wanted to, let's say, pay out the mortgage, you might be subject to an interest rate differential or a 3-month penalty if you're on a variable. So understanding the differences in the components between both products is obviously very important. Now, lines of credits generally operate on an adjustable or variable rate product, meaning that changes to the Bank of Canada's policy rate or overnight rate can trigger your payments to increase or decrease. So as we are now on the path to higher rates, we will see lines of credits become a little bit more costly depending on what you're using it for, and obviously how much money you're borrowing against it. And this is why it's very important to understand that the line of credit, if you're using it as a tool to invest and not to purchase things that are not going to help benefit, is very important. So let's say, for example, you take out a line of credit, you borrow $50,000, you want to put it into the capital markets to help you increase your wealth. Well, that's a balanced transaction in some regards. Obviously, there could be volatility between what happens in the market and what you're paying, but as you're paying down your loan, your actual wealth grows because of that capital compounded, etc. Right? So this is what is a balanced transaction in some regards. Obviously, there could be some deviation within that product, but generally, if you were to liquidate your investment, you can cover the majority of your line of credit, or more so down the road. So this is what we talk about also, and the same thing with mortgage components is, many Canadians will go out and pay their house, and then basically, are saving their money, but they're not able to basically access all the money because they haven't planned ahead for retirement. So now they're saying we need to access that money in the house, and now they're taking on a mortgage or leveraging it through a line of credit later on in their life, as opposed to starting at a younger age where you can start to invest, so that when your line of credit at home is paid down, you actually have some money sitting aside for you to do whatever it is that you wish to do during retirement and subsidize or help you in your golden ages or your golden years, right? So that is sort of the concept behind it. One thing to understand, as I mentioned, depending on the size of the mortgage or the home equity line of credit, rates can range from anywhere from prime, which is now 2.70%, anywhere from 0 to 1.5 and above. It all depends on the product, the lender, and if they're going in behind their existing product, or you're going out and getting an external home equity line of credit from a second or third party. So it all depends on what you're trying to achieve. So accessing home equity to leverage and invest has been a very powerful tool for many of our clients who are looking to diversify their portfolio, or maybe, as I said, approaching their golden years and haven't put enough money aside, maybe looking to assist their children or grandchildren with opportunities so that they can put that money aside and make it work for them. So obviously, as I mentioned right at the beginning, this is one of many strategies that you can deploy in your current situation. It is not designed for everyone, and you would need to speak with your financial planner or investment banker as well as your mortgage professional to understand the options and pros and cons based on your scenario. So we hope we found this video helpful. If you did, please feel free to share it. Maybe someone you know would be interested in this. Feel free to share that along with them as well. And we wish everyone a great Friday. Once again, we thank everybody for tuning in, taking time out of your day to watch us and help educate Canadians. So we wish you all the best. Have a great Friday and an even better weekend ahead.